Live from New York City this morning. Good morning, good morning. Back-to-back monthly gains on the S&P 500 for the first time this year, and we tried to add some weight to the recent rally. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, a not-so-subtle shift from the Fed chair.
We heard from Powell.
In terms of consistency of message,
Powell couldn't have been more different from Jackson Hole.
He was actually not, in my opinion, as hawkish as he could have been.
When you pull back the information that he talked about, he still said that we still have a lot of work to do.
But the things that the markets took away from it.
They're going to moderate the pace of hikes going forward.
That indication that the days of 75 basis point rate hikes from the Fed may be at an end.
It becomes a little bit of a vicious cycle.
Treasuries rallied, especially at the short end.
Anytime, the Fed sounds even a little bit dovish, then you're going to see this risk-taking.
It's already happening effectively, and it's really just down to the Fed now to manage that transition.
Joining us now to discuss is BlackRock's Jean Bavin and Principal's Seema Shah. Seema, first to you. What's behind that shift, the difference between this Fed chair that we saw yesterday and the one I saw at the last presser?
Yeah, I don't think he said anything substantially new. He repeated the idea that there's going to be a downshift to 50 basis points. I think that was already fully priced into the market. There can't be even one person out there who would have been surprised by that. But maybe the big thing was that coming into the meeting, some people were worried, of course, that he would take a slightly more hawkish perspective, pushing against the slight easing of financial conditions, and he didn't. And of course, he talked a little bit about not wanting to over-tighten. Really, look, the market's had what it wanted to hear. We've had this rally in the last couple of weeks. It wanted to hear something dovish, and that's what it heard. It's what he didn't say, isn't it? He did not lean against easing financial conditions. I think we all found that notable. And Jean, I was making notes as he was speaking, and I was comparing it to what I heard in the news conference. The shift in emphasis from the Fed chairman in the last 24 hours, from yesterday to the press conference, he's gone from talking up asymmetric risk, the risk of doing too little outweighing the risk of doing too much, higher for longer, a higher terminal rate, maybe a month or so ago. And yesterday he's talking about not over-tightening and highlighting the slower pace to manage that risk. What did you make of that, Jean?
Well, I agree with what was just said in the main, and I think I don't see necessarily a big shift. I see maybe some communication, noise here. I think at the end of the day, when you parse through this, key things he said to me were like one clear sentence at the end was around the fact that what matters is the terminal rate, the level, and how long they're going to have to stay there, much more than the pace at which now they're going to be delivering those hikes. And I think that's the key message here. And at the end of the day, taking a step back, their frame is all about inflation. There's nothing about managing trade-offs. So at the end of the day, we can listen to what he says and so on, but it's going to end up being about inflation. And on that front, I don't see any room to be dovish, any justification to a big shift from the press conference. So I think this is a bit of noise at this stage.
Jean, at the end of August, he talked about causing pain. He said pain was part of the story to reduce inflation, the unfortunate cost of reducing inflation, but a failure to restore price stability would mean even greater pain. That was the speech over in Jackson Hole. That Friday, we closed lower by more than 3% on the S&P to 4,057. Yesterday, we were at 4080. Does it make sense that the S&P is back to where it was basically at Jackson Hole?
No, I think the markets are primed to hold on to any bits of dovish aspect that we see now as a justification for a rally, which we very much see as a bear market rally still at this juncture. And I think what he really whether he mentions the pain that is needed or not, it's going to be needed. So if you insist on bringing inflation down, there's no way around it. So I think our advice is to focus on what's needed to get there, no matter the noise on the way from the Fed that will come.
So, Seema, would you fade this market rally?
Look, I think technicals can take it a little bit further. The market wants to hear the dovishness. They've got the data that they wanted to see. As we heard Neil Dutter talking great interview yesterday, the economy is pretty resilient. So there is this idea that there is maybe a path to a soft landing. Now, beyond the next 3 or 4 months, no, absolutely not. This is not a market that can be sustained. Take a step back. In the last, we've seen the Fed raise rates by almost 400 basis points. And they haven't done that in the process of a couple of years. They've done it in less than 12 months. And yet the market is only down some 15% or so. That doesn't seem enough to me. So take a step back, look at the fundamental picture. There has been a significant tightening in financial conditions, and the economy is still very strong. At some point, those chickens are going to come home to roost, and there will be equity market weakness.
Well, they're not right now. We're adding some weight to the recent rally, up another third of 1% on the S&P 500. Back in the middle of November, John, you and a team at BlackRock said the Fed is still on a path to create a recession via policy over-tightening. Stocks aren't pricing that in. We stay underweight. Have you changed your mind in any way, shape or form, Jean Bavin, in the last couple of months?
Just put out our outlook yesterday, and where we are right now is exactly where we were when the last time we spoke. So I don't see the conditions yet in place to this is a recession foretold. It's going to have to come because that's the only way to bring inflation down, as long as they insist on bringing inflation down to 2%. At the end of the day, we think sometime in 2023, they'll have to back off from this. Maybe markets are seeing some glimpse of that, but we're not there yet. And I think the real story here is, it's ready to monitor, try to see how much damage we will get at the end of the day, and how much of it they wanna inflict. And once we have greater clarity on this, then we'll see the basis for a more constructive environment. But this is a few months away, certainly, and this is a 2023 story.
Well, the economic data is in the driving seat now. It's payrolls tomorrow morning. Then in a couple of weeks' time, we get CPI. Yesterday on the S&P 500, the biggest one-day rally going back to the November 10th CPI print. Kelly Lyons has more. Hey, Kelly.
Hey, John. It was a monster rally, and the first thing Mike McKee and I did this morning when we saw each other in the office was ask each other what was that about. And I really think that the conversation you were just having kind of nails it, in that it wasn't necessarily that he didn't say anything new. It was that he didn't say anything newly hawkish, and that seems to be what this market was clinging to. So as a result, you got a big rally in the S&P 500, an even bigger rally in the NASDAQ 100, which was up about 4.5% yesterday. Both of those indexes hitting their highest since mid-September, and the gains are continuing this morning. Interestingly as well, volatility coming down substantially. The VIX index volatility fear gauge is now at a 20 handle, and of course we got the monster rally in the bond market as well. The 10-year yield dropping 14 basis points yesterday, the 2-year by 16, and not moving quite as much this morning, but it is holding. You aren't seeing a reversal of that. And of course, that front end move in particular reflecting the move lower in expectations for ultimately what the terminal rate will be. Even though Powell reiterated the message that they may be moving slower, but they could ultimately be moving higher, market pricing went lower in terms of the peak Fed rate, actually indicating that it could potentially be below 5%. And maybe the cooler PCE deflator month-on-month figures we got this morning feed into that narrative. But of course, as you mentioned, John, we're not done with the data yet. We still have the jobs report and CPI before the Fed decision in mid-December. And of course, the expectation for that decision, which the market seems to have gotten solidified by Chairman Powell yesterday, even if he didn't say as much in so many words, is 50 basis points. And then the hike for February being smaller, and March almost seems like a bit of a question mark at this point, because right now, John, only 15 basis points priced in.
Hey, Kaylee, thank you. That's the Fed story. On the horizon, earnings. And overwhelmingly now, the consensus view is, yes, this bear market rally can continue, but ultimately, in the first quarter of next year, we get slapped around the head by reality, and that reality is weaker earnings. Even Marko Kolanovic at JP Morgan on board with this view. This is what he had to say. Previous lows in equity markets are likely to be retested as there may be significant decline in corporate earnings. We are inclined to think that this market decline could happen between now and the end of the first quarter of 2023. Seema Shah, how consensus has that view become?
Well, look, I mean, finally, we're in agreement with Marco on that. I think it's consensus in that the first half of the year is going to see a very, very significant earnings slowdown. I think we'd push back in terms of the timing a little bit. Actually, we think it could be pushed out to Q2, partly because actually our recession forecast, we pushed it a little bit further out, given this very important economic resilience and labour market resilience that we've been seeing today. But certainly, yes, 400, however much it's going to be, we're thinking 500 or so basis points of tightening. At some point, that is going to have an impact on earnings. And that is the time that we're looking for this almost second leg to the equity market downturn.
Jean, are you in agreement with that, just in terms of the timing?
Timing is difficult, but as you know, when we've talked about earlier, our main view was that this earnings recession, this earnings outlook was not in the price. We thought that the rate path was more in the price when we last talked a few weeks ago. Now that disconnect has reappeared. So that on the two front now, we're seeing a disconnect between reality and what market are currently pricing. I think one feature in terms of the timing that's going to be unusual in this environment is that this recession is foretold, as you say, like this is becoming consensus, and we haven't really seen it yet. So I think we could see markets looking pricing it sooner before we actually see it, even the data, and look through it at some point. But that's going to be after some adjustment, some repricing.
John, there's one interesting point that I want to make, and it's from your outlook, and it really stands out to me. When I hear from Bank of America, it's buy bonds in the first half. You hear that from Michael Harney. You heard it from Michael this morning from Morgan Stanley, Mike Wilson. And I just wonder from your perspective, John, why you don't think the bonds are going to work this time around.
So there's a distinction to make at the outset, which is like, short-dated bonds are pretty attractive. We're getting yields now that are like, instead of staying in cash, you can get a very decent yield, something we haven't seen in a very long time. And there's a very significant lure of bonds in that sense. When it comes to the long-dated bonds and, thinking of the usual playbook of a recession is coming, you want to hide in bonds, that we are skeptical of this. I mean, this is a recession that is foretold. This is a recession that is needed to bring inflation down, and the causality runs the other way. So in this typically in a recession, you see inflation surprising, it comes, and then you can see downside surprise on inflation. Here, the question is how deep the recession will need to be to bring inflation down enough. And that means that the central banks will not be to the rescue here or providing cushion on the downside. And I think in that context, we shouldn't expect duration and long-term bonds to play the same kind of badass role they've been playing. So that's not a read-through for us. And in fact, we see other structural trends that will be pushing yields higher, especially given that we've seen a pretty significant inversion of the curve now and long-term rates that have fallen instead of increasing. So that is a basis that is much more fragile and makes us very cautious on bonds.
That's a pretty contrarian view. Seema, your thoughts on it?
I mean, look, I think there's some really good points made there. This is going to be a year where the Fed is unlikely to be cutting rates, at the earliest, right at the end of 2023. So maybe you don't see as much downward pressure on the long end as maybe you traditionally would, but I think there is still some downward path to go. So we do think actually that treasuries are a decent place to hide out. We also think that actually investment grade, right? So, first half of the year still looks to be pretty resilient. You only get into recession in the second half of the year. So that means that credit spreads, although they widen a little bit, it's not as, we don't see the kind of default activity that we could have seen previously. So I think there is an area for core fixed income to outperform. Certainly we have increased our exposure within the last couple of days, just an acknowledgement of that.
Seema Shah, Jean Bavard sticking with us. I'm preoccupied with the moves in foreign exchange. Look at these moves right now. Cable, sterling against the US dollar, 122.35. The lows of the year, 103.50 intraday. That was at the back end of September. Take euro dollar on the session, just through 105 briefly. 104.98 right now, up 0.9% on the session. But from the lows of the year, again at the end of September, we have gone from 95.36 to 104.99 in just a couple of months. And last month, the DXY, the dollar, through the month of November, worst month since 2010. Brutal. Coming up on this program, Secretary Yellen making her late night debut.
You used to be the head of the Fed, chairman of the Fed. What goes on in there? And you guys wear robes and sacrifice a goat, and then and right before the goat bursts into flames, it tells you the new interest rate hike that you're supposed to say. How?
That conversation up next.
Head of the Fed, chairman of the Fed. What goes on in there? And you guys wear robes and sacrifice a goat, and then and right before the goat bursts into flames, it tells you the new interest rate hike that you're supposed to say. How what is it? Why is it so secretive?
It was thought once upon a time, I can no longer remember why, but that monetary policy would be most effective if it was most secretive. And the truth is that the Fed never even announced to the public what decision they had made about monetary policy.
Janet Yellen, the former Fed chair, and now Secretary Yellen, of course, on The Late Show, on Stephen Colbert, on CBS. AMH with us down in Washington, D.C. Anne-Marie, is this the rehabilitation of the Treasury Secretary?
She's doing quite a lot of press, right? And she put to bed those rumors that potentially she would be departing the administration after the midterm elections yesterday at the Deal Book conference, saying that she plans to stay on. And now what we know from this Colbert interview, Jonathan, that she's been practicing her signature to make sure it's legible, as opposed to those of her predecessors. And this is kind of a funny moment, right? Because she's this widely accomplished economist. She was the Fed chair. She's now the Treasury Secretary. She's been practicing her signature. But it would be historic when those bills come out in January, because it'll be the first female Treasury Secretary to sign our U.S. dollar bills.
If you don't remember what Jack Lew's signature used to look like, I suggest you all go on Google and have a little look at those weird squiggles that I still don't understand. Let's get to the news right now in D.C., where you are. Happening right now is that meeting between Francis Macron and the President of the United States. This is what Macron said to ABC a little bit earlier this morning, Anne-Marie. The US CHIPS Act and the Inflation Reduction Act were not properly coordinated with the European economies and create the absence of a level playing field. AMH, we anticipated there would be some tension on this issue. How do you expect it to play out today?
Yeah, first state dinner, Jonathan, since 2019, and tensions on the table along with the lobster. Listen, this is a big deal for not just Emmanuel Macron, but you've heard this from other European officials. They take aim at the U.S. CHIPS Act. They take aim at the Inflation Reduction Act and the subsidies and the leverage it gives to American companies. And what Macron said in this interview with George Stephanopoulos of ABC News is that he wants to now synchronize the relationship. And his issue seems to be that the communication wasn't there before this legislation happened. And now that it's legislation, it is very difficult for the U.S. to go back on it and make it what Macron would say a more level playing field. Although the U.S. really pushes back on this, there's not much investment in this. Treasury Secretary Janet Yellen said just yesterday that she does not find this unfriendly because right now China has so much of the supply chain and that this is good for everyone involved.
Can we get a final word on strikes? If there's a man that knows something about strikes, it's the French leader. AMH, I wonder how that's going to play out between the two of them a little bit later.
Well, we have to wait for the Senate, and we could see that bill that was passed in the House that would make this legislation the tentative agreement that this administration talked about in September in the Rose Garden, that they were able to broker a deal between the companies and the unions. But at the end of the day, rank and file of all the unions did not sign off on it. It now goes to the Senate, and the tricky part is going to be not so much the tentative agreement, but the provision, Jonathan, on the Medicare and paid sick leave. Only 3 Republicans signed up for that provision in the House yesterday, even though the main agreement passed largely on a bipartisan vote. So you have this issue about individuals, especially on the progressive side on the Senate, like Senator Sanders. If that provision is not passed, will they vote no on the entire deal? And time is of the essence. It is December 1st, and they have a December 9th deadline.
Anne-Marie, final word. News conference a little bit later. What time is it?
I believe that news conference is in the 10, 11 o'clock hour, depending how the timing goes. So once again, there's policy that is interrupting very important games, especially Croatia and Belgium.
Very true. They need to speed this stuff up. I'm with you, Anne-Marie. Jay Powell was doing that yesterday, counter-programming with Argentina. Not on. Anne-Marie, down in Washington, D.C.
Poland, the Poland game.
I know, brutal. John Bervan and Seema Shah back with us for a final word. I want to come to the both of you on this, and it was from Deutsche Bank, looking ahead to next year. What are we getting wrong about next year? And this is where I start to look at consensus and wonder where the scope for upside, downside surprises are. Deutsche Bank said this: it's worth remembering that exactly a year ago, markets were pricing a Fed funds rate of 0.68% by the end of 22 and CPI at 2.6%. They went on to say, given the huge forecasting miss over the last 12 months, it's remarkable how settled the consensus is around a terminal of 5%. I went into the projections of the SEP for December last year, looking 12 months out, and the Federal Reserve itself had Fed funds at 0.9% at the end of 2022. Fed funds is likely to finish at 450. Seema, the final word goes to you on this one as well. What do you think we're getting wrong about next year?
Look, I mean, I think that's a tail risk. That is a clear tail risk. When we think about inflation, history tells us that it is almost impossible to get inflation once it goes above 5% down to 2% within 2 years, let alone 5 years even. So I think consensus is moving in slightly in the wrong direction. I think if I had a tail risk scenario, it would be that we get to the second half of next year, we have got inflation just falling very, very slowly still, and then the Fed has to introduce more rate hikes. The market has not priced it in at all, and I think that would be a very, very negative surprise. It's a tail risk, but we have to have it in the scope.
Jean, what about you? Lessons of 2022 looking out to 2023?
I would say two. One is in line with what was just said. I think the idea that the Fed will be cutting in 2023, I think, is very difficult to envision. So it's not for me a tail risk. I think this is like not in line with the baseline, and I think we're seeing more upside to the curve and the policy path from here. The broader lesson, and this is reflected in our outlook, is that we used to be approaching the year ahead with like a view about how to do tactical asset allocation in a way that would be holding up for the year. I don't think we can approach it this way. So we've spelled out like the scenarios we think might be panning out in 2023, and I think to get it right, it will be about like nimbly be willing to adjust and react to what's happening. But if I had to make a call, the biggest mistake we're going to make is expecting things to be so benign and rates peaking at 5. I think they're going to be peaking higher than that for policy rates.
So, John, how high?
No, I think we're going, I mean, we were not going to massively higher, but I think we can get like to the 5 range. I think that would be already pretty significantly different from what we're expecting now. And when you look at the range of historical outcome, I mean, that's not like very far from that peak, but it would be materially different from what the market's currently pricing.
Jean Bavin, brilliant to catch up with you, sir, on the new outlook for 2023 from BlackRock. Jean Bavin there, alongside Seema Shah. Equity markets look like this morning at 0.4%, about 7 or 8 minutes away from the opening bell, adding to the back-to-back monthly gains we had on the S&P through October, up around 8%, through November, up around 5%. The rally continues. In the bond market, almost unchanged at the front end of the yield curve on a 2-year, up almost a basis point to 432 on a 10-year, down about a basis point to, let's call it 360, just a break of 360 this morning, and more dollar weakness. Euro dollar just south of 105, cable sterling against the US dollar 122.40. That's the price action coming up. The morning calls, and later Powell's remarks adding more than $1 trillion in market value to the S&P 500. That conversation with Chris Harvey of Wells Fargo around the opening bell. 5 minutes away from the opening bell as we kick off the trading day, and December, that's just around the corner. Futures are positive by 0.4%. As the price action, let's get you some morning calls. First up, Morgan Stanley downgrading Capital One to underweight, growing more cautious of the consumer finance sector due to the challenging macro landscape. Your second call from Jefferies, cutting its Salesforce price target down to 230, pointing to the stock's limited visibility after results. We're down there by more than 7%. And finally, Citi downgrading Sirius Radio to sell from buy, cutting shares by 2 notches ahead of its potential combination with Liberty Live Nation. Their stock is down by 1.5%. Coming up, Chair Powell putting a floor under stocks, regardless of the upcoming inflation print. That's the view of Chris Harvey of Wells Fargo, and that conversation with Chris is up next. Equity futures just about positive. The opening bell just around the corner. Closing out November with the first back-to-back monthly gain on the S&P 500 of this year so far, and looking to add some weight to that rally as we kick off December. Equity futures right now up 1/3% on the S&P 500, on the Nasdaq 100 up around about 1/10%. The small caps, the Russell, up 1/2%. Let's see opening bell, switch at the board and get to the bond market. 10-year Treasury yields through November down about 40 basis points. This morning up about 1 to 362.55. In the FX market, some real dollar weakness. Euro dollar through 105, positive 0.9%. Pound sterling against the US dollar up by 1.6% today to 122.56. I keep saying it, I know, but wow, what a turnaround from the end of September, from 103.50 to 122.50 on pound sterling. Quick look at crude, up by 2.6%, 82.67 on WTI. 30 seconds into the session. 30 seconds into December, equity futures are positive, and now stocks are too, up by more than 0.2% there and thereabouts on the S&P. On the Nasdaq, up by almost 0.1%. Let's talk about the new consensus. The long-time equity bull, Marko Kolanovic at JP Morgan, is starting to sound a little bit more like Mike Wilson of Morgan Stanley. Take a listen to this quote. Previous lows in equity markets are likely to be retested as there may be a significant decline in corporate earnings. We are inclined to think that this could happen between now and the end of the first quarter of 2023. Mike Wilson weighing in on a new consensus.
Our call this year now has become pretty much consensus, but that's why we flipped in October, quite frankly, is we felt like that call, the fire and ice call, right, Fed tightening into a slowdown, became consensus. Now we see kind of this idea that we're going to make a lower low in the first quarter. I don't think that's quite consensus yet.
Katie Knights has more. Hey, Katie.
Hey, John. Well, just a reminder of where we've come in the last 2 months. First back-to-back rally, we have seen positive months for equity markets going back to the summer of 2021. And over the last 2 months, we've actually rallied about 14% on the S&P 500. But of course, as you said, it's a new month now. Will the rally go on into year end? If you look at the Trader's Almanac, the Stock Trader's Almanac, it finds that it's extremely rare for stocks to undergo heavy selling in December, which is actually the third best month for the S&P historically, going back to 1950, with an average gain of about 1.5%. And that does seem to be the consensus on the street as well, that the rally can continue. Happy holidays, everyone. But then when we get into 2023, it's a very different story. And to extend from what your conversation was with Mike Wilson this morning, he said he does think this rally can keep it up in December, but he thinks we could go as low as 3,000 on the S&P 500 in the first 3 months of the year. And JP Morgan, you read a little bit of that, the publishing from this morning, thinks we could test new lows in the first quarter, which could mean down 12% from here. And Binky Chadha is actually looking out even further over at Deutsche Bank. He thinks by the third quarter, the index will drop to 3250 in that period as the recession begins, which is 20% downside from where we are now. Then, though, he sees a rebound, and pretty much everyone else does as well. The average target on the street is actually that the S&P 500 is going to end next year very little change from current levels. But keep in mind, current levels still has the index down about 14% on the year. And typically in years where we see double-digit declines on the index, the next year usually brings a rebound, often a very sizable one to the tune of 20% or more. The question, John, as it always seems to be, is this time different?
Katie Knights, is it? Thank you. In October, the equity market was up 8% on the S&P. In November, the S&P was up by more than 5%. And we're all asking the same question, just how much upside is left in this equity market rally?
We've seen this big rally over the last sort of 6 weeks or so.
There's a huge relief rally.
I think we're probably getting towards the peak of that.
This year was all about valuations coming down and earnings hanging in there.
Well, we're clearly seeing the slowing down of the U.S. economy.
Next year is going to be some valuation relief.
I'm simply not of the belief that we have actually hit the bottom.
We still have a recession penciled in for the first half of next year.
Things are not, or the tang, Tom, but, you know, things are not looking good right now.
We're probably in for a period of below trend returns in the equity.
We'll start to see some disappointment maybe as we move into 2023.
There's never been a bear market that ends before the recession starts.
I do think that the low is in.
It's coming, but it's coming next year, not now.
Chris Harvey of Wells Fargo says stocks have more to run. This is what he has to say. Powell's remarks seem to have taken the teeth out of the upcoming November CPI report. The equity downside associated with a hotter CPI print becomes limited. Chris, I'm pleased to say, joined us right now. Chris, I guess we should start with the chairman yesterday. What did you learn from that delivery?
Yeah, so a lot of people are scratching their heads because you listen to what he had to say, and it's pretty standard fare. Hey, we're going to get to very restrictive. We're going to stay there until we break the back of inflation. The only thing he really added to it is the market believes he's blessed 50 basis points, right? And what does that mean? I think that means three things. As you point out, I think what it does, it takes the teeth out of the CPI report, because why were you afraid of the CPI? If it comes in too hot, then maybe the Fed goes another 75 basis points. They get a lot more hawkish and we see more downside. Well, we have to take the CPI off the table at this point in time, or really a lot of the downside off the table. Two, if you look at real rates have dropped like a stone, or they dropped like a stone yesterday. 10-year real rates dropped 22, 23 basis points. Why is that important? That's important because lower real rates have been associated with a better returns to growth. And what is the equity market? It's a growth index. And the last thing that we've been saying is the sell-off year to date is really about a cost of capital correction. It's not because the fundamentals have imploded, right? This is not 08 where we've seen companies like Freddie and Fannie and Bear Stearns and Lehman Brothers go belly up. What this is about is the cost of capital is more than doubled. So if you're lowering the cost of capital, which is what the market did yesterday, then you should see a pretty good pop because the fundamentals haven't broken. So all in all, you've taken the teeth out of CPI, you've lowered real rates, and you've lowered the cost of capital. In the short term, I think that's going to push the equity market up another 2 or 3% in the coming weeks.
Chris, hearing from Fed Governor Bauman, inflation is unacceptably high. The labour market is strong. You said we've taken the teeth out of the CPI print on December 13th. Right. Have we taken the teeth out of the payroll story tomorrow morning?
No, I don't. I think any one data point you can get a very big number, positive or negative, right? And the market will react to that. Market is still very sensitive. Like, good news in the job market is going to be seen as bad news in the equity market, right? But what's happening holistically and what's occurring? You know, we've been talking about inflation. When do we start looking through these inflation prints? You know, the market is now beginning to believe that inflation is rolling over. Inflation, the Fed has got it. Things are going to slow down. And I think that's part of what's happening right here. But to answer your point, yeah, any one print could be exceptional and move the market. But overall, what we're seeing in the job pictures, things are beginning to ease up. What we're seeing in inflation is all your leading indicators have rolled over and things are beginning to work.
Chris, do you think we're getting a little bit too cute about the outlook, the trajectory for 2023? There is this new consensus that's been established, the idea that we get this first half of weakness off the back of bad corporate earnings and this second half of strength as the Fed starts to make a bigger pivot. Chris, I just wonder what you think about that.
Yeah, John, I think a lot about that. So in the summertime, we had this conversation. We had this conversation that numbers weren't going to go down, they weren't going to be as bad as expected, but you were going to see numbers come down in the beginning of 2023. And that was going to be weighing on equities. And I do think that's now become the consensus view. The thing that's changed now is we now have a better idea of when the Fed is going to end, where the top in rates will be. And during the middle of this year, there's a lot of questions. Well, we can't find an equity bottom if we don't know where the top of rates will be. Now we have a much better understanding of that. And I do think we're getting a little bit too cute. I do think it's becoming more consensus. And as it becomes more consensus, the probability becomes less. And so we've got to watch very carefully about what rates are doing. And that's going to be very important because of the growth component in the market and how sensitive or how duration sensitive it is.
Where do you think the greatest earnings challenge will be in the upcoming quarter?
I think it's going to be more so. You've seen some pretty good and some pretty big deratings on the growth side. I now think it's coming more so on the cyclical side. If you listen to Chairman Powell, and we're late in the cycle, and this is not unexpected, what he's looking for, what he wants, what he needs is an economic malaise. Because what he's saying is we've got to get that job picture down. The way to get the job picture down is to decrease demand, right? And so as a result, the economy is naturally slowing, but the Fed is going to force that. And where you're going to see the numbers change and change more so is on the cyclical side than the growth side. And what we're telling clients is you really want to go, if you're going to invest, you really want to go to where expectations have been lowered. And one of the places where expectations have been lowered more aggressively is on the small cap side. And that's something we're much more positive on today. We did upgrade small caps about 2 or 3 weeks ago, partly because expectations have come down pretty dramatically.
Chris, yesterday, Microsoft up 6%, Apple up 5%, Tesla up 7%, Amazon 4%, Google 6%. What about big cap tech, Chris?
So we're still short software, right? We've been short software or underweight software for the last year and a half. And what we've been saying is it's working. The risk reward is changing, and the dynamics that we're looking at for growth are beginning to change. So we're viewing these things. We're not as negative as we were before. We're viewing this as the risk reward is beginning to change, and as that risk reward changes, I don't know if tech is going to be that leadership, but I do think there's a lot of idiosyncratic growth stories that are very attractive. There's a lot of former high-flying growth companies that are now growth at the right price. And that's really what we want on one side of our portfolio. We want these GARPy names. We want names that can work in a lower growth environment where inflation is more benign and they can power through the situation.
We want you back on this show soon, Chris, before year end. It's been great to catch up. Chris Harvey there of Wells Fargo. Thank you, buddy, as always. 10 minutes into the session, we're up 1/10% on the S&P. On the NASDAQ, we're up almost 0.2%. Shares of Credit Suisse, to pick out one single name, falling for a 13th consecutive session. Close here. Longest losing streak on record. Abby has more. Hey, Abby.
Hey, John. Well, this is really pretty incredible. As we have stocks rallying here in the U.S. 2 months in a row, we have the shares of Credit Suisse, both in Switzerland and the ADR here in the U.S., absolutely quietly plunging, and that record streak to a record low, as you were mentioning. The recent move lower, because this, of course, comes in a greater than 95% fall from the peak, has to do with the recent rights offering that could bring dilution. Now, before we speak more about that, the reason that they have the rights offering as a part of that $4 billion capital raise announced a few weeks ago for the transformation of the company, because, of course, they've been racked by a number of scandals. They've also talked about a fourth quarter loss potentially of $1.5 billion. Lots of money coming out of their key asset management business. So lots of problems here. And Archegos was one of those scandals. Lots of fines paid over, not just the recent years, but they've had a lot of scandals and problems over the last decade or even longer. But as for that rights offering, John, 2.52 Swiss francs, that's the key level. If the stock in Switzerland can stay above that level, then perhaps the dilution will not happen. But if below that level, according to one analyst, it could really be a problem. And it will be interesting, John, because you can see that this recent selling, all of the selling, the last peak closer to 2,000, it's on higher volume. But if it holds that level, will investors see some sort of near-term trade there as this company tries to get itself together? But certainly catch a falling knife there.
Abby, thank you. Thank you very much. It's a challenge to hold on to clients in an environment like this one. We heard from the Credit Suisse chairman a little bit earlier this morning, who said we have had very few clients leaving. We will see client money coming back. We actually heard from the UPS chairman at a conference in London in the last 24 hours, who said we are not actively benefiting at their expense. He went on to say, we view them as a worthy competitor going through a crisis which I believe they will manage and get to safer ground. But we are also in a world of clients moving money around where clients proactively approach us. An indication from UBS that Credit Suisse clients are going to the bank proactively. The latest. I just can't believe we're seeing a two-handle on Credit Suisse this morning. More on that, no doubt, through the next month or so, going into a new year. Coming up on this programme, investors turning their attention to Friday's payrolls report.
Recent research by Fed economists finds that the participation gap is now mostly due to excess retirements. These excess retirements might now account for more than 2 million of the 3.5 million person shortfall in the labor force.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, General Motors CEO Mary Barra. That conversation at 3 p.m. in New York, 8 p.m. in London. This is Bloomberg.
Overall participation, however, remains well below pre-pandemic trends. Recent research by Fed economists finds that the participation gap is now mostly due to excess retirements, that is, retirements in excess of what would have been expected from population aging alone. These excess retirements might now account for more than 2 million of the 3.5 million person shortfall in the labor force.
Chairman Powell and investors alike paying close attention to the labour market. The US payrolls report less than 24 hours away. This as DoorDash plans to lay off 7% of its workforce, joining the growing list of tech firms cutting jobs. The CEO writing in a letter to staff, while our business continues to grow fast, given how quickly we hired, our operating expenses, if left unabated, would continue to outgrow our revenue. Ed Ludlow joined us now on the West Coast alongside Mike McKee here in New York. Mike McKee, I want to start with the data ahead of payrolls Friday. It's the data we got just a minute ago.
Yeah, we just got the S&P version of the PMIs for manufacturing for November. Now, this is a final. It's 47.7. Their preliminary indication was 47.6, so marginally better, but still below the 50 line that theoretically tells us whether business is contracting or not. It is different construction a little bit than the ISM number at the top of the hour, but both will get some attention today.
I think we're looking ahead to the ISM employment component as well, given what happened with manufacturing in the ATP, and payrolls just around the corner. Speaking of payrolls, Ed Ludlow, the job losses in tech just piling up and piling up.
Yeah, the data is staggering. DoorDash, interesting because it's a company that continues to grow both in terms of bookings and the top line, but they're trying to unwind the pandemic era mega growth, right? It's a similar story in Amazon, trying to unwind the investments that they made, and they've become bloated, so they're starting to cut jobs. I actually want to get straight to the data, John, from Challenger Gray, because it is staggering. In the month of November, the technology sector announced almost 53,000 jobs to be cut, taking the year-to-date total to around 81,000. I'm actually going to say that again, John. 53,000 job cuts announced in tech in November, taking the year-to-date total to 80,000, all of it coming in the month of November. That is the biggest month since this firm, Challenger Gray, started recording that data set. And the year-to-date total of 81,000 jobs announced, the biggest since 2002. So something clearly happening very sharply in the technology sector. The other piece of data that really caught my eye, John, and I'm grateful to be on the show this morning for that reason, the majority of job cuts announced in November came from the West Coast in particular. And so that is worth looking into. Pay is also a really big issue right now because people are looking for new jobs. You know, we've been talking a lot, for example, about Twitter, those that left of their own volition and those that were laid off. Well, I know, talking to sources, the kinds of firms they're going to, but they're not able to command as high a pay as perhaps they had at their previous firm, which is an interesting dynamic when we think as well about inflation in the context of wages.
Hey, just how much excess is there? I saw a Wall Street Journal story over the weekend that was explaining just how much the likes of Amazon and Meta have grown through the pandemic. We're talking about a workforce that have basically doubled at some of these tech firms.
Yeah.
How much excess do we have left that we need to remove?
There is excess, and I'm hearing from a lot of folks in this town and broadly out in the Bay Area that are struggling to find a job. But a lot of venture capitalists will say something else, John, which is that if you go back to the dot-com bubble, 2008, when you see layoffs like this, you actually release a lot of talent. And what that talent does is they found their own companies. Good companies are born out of recessions. And what's interesting is that dynamic itself is also offset by this idea that a lot of mid to late stage growth companies right now in the private space are also being told by their boards to have discipline and not hire like crazy. So it's a really hard balancing act. But yes, there's excess. I think what will be interesting, and we see to give, actually, is if they might be overdoing it a little bit. You take HP Inc. as an example, up to 6,000 jobs over 3 years. But what we're understanding there is that actually they want to give themselves flexibility, because if you cut too hard, you may not be able to hire those people back, and then you're left stranded if we see a quick turnaround in the economy.
Ed, thank you. Appreciate it, buddy, as always. Mike, I want to give you the final word on this as we push ahead to tomorrow morning. Mike, we just start with Challenger. Maybe some people out there not familiar with Challenger job cuts. How useful is that data, Mike?
In a directional sense, it gives you an idea of how things are going, but they include potential job losses, not just from firing people, but attrition, and if you're cut back on hiring plans, it all goes into that. So it doesn't really mean that 81,000 people are losing jobs, but you want a final word on this. 81,000 jobs lost, even if that were the actual number in the month of November. Well, in the month of October, the economy cut 360,000 jobs. Now, we saw job gains because more people were hired, but that kind of churn goes on all the time, and you can see the relationship of the tech industry to the overall economy. 153 million jobs out there, so 81,000 isn't much. Gets a lot of headlines, but it's not really a story of what's going on in the labor market right now.
Final word on jobs tomorrow, Mike.
I think what we're going to see is a slowdown. That seems to be the indication. We'll get a better look when we get ISM. You mentioned the manufacturing employment numbers. But it's also important to keep in mind that what happens is unemployment doesn't tend to rise until after the Fed stops raising rates and even starts cutting rates. So there's a very good chance that if we're going to have labor market problems, we haven't gotten there yet. So no matter what the numbers say tomorrow, it isn't going to be the final word.
ISM in about 8 minutes. Mike's going to break that down with Alex Steele, Guy Johnson and the team in 8 minutes' time. Payrolls Friday just around the corner. Equities right now about 22 minutes into the session, positive 0.4%. We had some weight to the rally through October, through November, now into December. The Nasdaq up by 0.5%. Let's get you some sector price action. Here's Abby.
John, we have something interesting happening sector-wise that suggests that investors really do think that the Fed could back away. And what I'm talking about is we have utilities and real estate, two of the top three sectors up about 1% apiece. These sectors, of course, give high dividends, have these companies' stocks offer high dividends, and that would be competition to yield. So if this strength for utilities and real estate continues, it suggests that traders, investors think that yields will go down, perhaps on the Fed being less hawkish than previously expected. As for those 2 months, take a look at this, John. All 11 S&P 500 sectors higher for the quarter so far. Energy, industrials, materials, old school, old economy sectors leading the way. And then take a look. The worst sector underperforming, up 1.4%. Discretionary, as we still figure out what's happening with the U.S. consumer.
Abby, thank you. Stocks advancing, your trading diary up next.